Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast. Our mission is to help you build and maintain massive amounts of cash flow through income producing real estate investments. Now, our guest for this week's show is real estate expert Gary Jonas. Now, Gary is the lead visionary and founding partner at the Howell Group, a one stop shop real estate firm located in the greater Philadelphia area. Now, one of the Howell Group's core competencies is providing A-plus apartments at B-plus prices. Now, these units are high-quality builds in the best part of the city without all the unnecessary amenities. Gary really coins this as his bulletproof real estate approach. And so, guys, with that, I'd like to welcome Gary Jonas to the show. Gary, my friend, how you doing today?
I'm doing wonderful, Kevin. Thanks for having me.
I'm excited to have you here, man. Excited to talk shop, and I know that I guess I grew up not too far away from Philadelphia. My joke, the joke about all that is Harrisburg. It's the capital. It's such a small town, though. I know it's growing, but when I got started in real estate when I was 19 and 20 and living in Harrisburg, we used to have to drive. There was no real estate investment clubs in Harrisburg. They didn't exist. There wasn't anything in York. There wasn't anything in Lancaster. Now there is. I'm sure there is. But we used to have to drive the King of Prussia all the way down to your neck of the woods to actually attend once a month a real estate conference. So anyway, I remember those days on the turnpike heading down to Philadelphia from Harrisburg. But anyway, but excited to have you here. Excited to have another fellow Pennsylvanian here, or this is another joke. Maybe you know this or not. I didn't know it when I lived in PA, but when I moved away, I find it quite funny is that it's the only state when you're from Pennsylvania, it's the only state where you actually refer to it by its initials, and everyone knows what you're talking about. When you say you're from PA, you just by happenstance you say it, right? Like it just
Yeah.
that's what you've known growing up. There's not another state that actually does that. No one says I'm from NC or I'm from NJ or I'm from NY. They don't do it. PA though, you say PA. You don't say Pennsylvania. I'm from PA. So anyway,
I like it. I love to go over all our Pennsylvania, Philadelphia stuff. That'd be
isn't that
fabulous.
funny? Isn't that funny? Well, Gary, excited to have you here again, and excited to dig in, learn a little bit more about the Howell Group. And so, for those folks that are not familiar with you, don't know who you are, don't know your background, maybe take a few minutes. I gave you that brief introduction. I know there's a lot more to the story than that. Take a few minutes and tell us a little bit more about yourself and ultimately how you found your way into real estate.
Sure. So, you had asked me earlier that, am I originally from Philadelphia in this area? And I am. I am born and raised in Philadelphia. Everybody in my family lives a couple minutes from each other, which is odd to my wife, whose family lives all over the country. But we just love it here, and we just think it's a wonderful place and a
Hmm.
wonderful market to be in. So, from a real estate investment standpoint, that's why we invest here. Kind of
Yeah.
my journey to getting there is I started in the mortgage business kind of by accident out of college, got in the mortgage business. And, you're taking applications for people. So you see where people are making money. And it was very clear that you either had to have a very high level of education or you need to be in real estate. Those were the
Hmm.
two places that everybody was making a lot of money. So that plus the idea that Rich Dad Poor Dad came out as a book, early 90s, I think, right as I'm starting my journey. And I'm like, this makes total sense to me. I need to own real estate. And my plan was to buy 10 properties that I would have paid off and would be free and clear by the time I was 45 and I was going to retire because I would have $100,000 in income. So that was 1993, Gary's plan for the real estate market.
Yeah.
Um, Over time that has evolved, but that's kind of where we started. And interestingly enough, it worked out really good for me because our mortgage business exploded. That business was doing
Hmm.
tremendous. It was making lots of money. And during that time, I had accumulated those 10 properties that I said I was going to buy. So I bought one or two properties a year for 5 years, and I was diligently trying to pay them off. And then what happened was the mortgage business, starts going sideways a little bit during, 2006 to 8 or whatever that time period was. And so by that point, I have three partners and myself. We're all running this major mortgage operation. And in 2 days, we have to decide like, hey, Countrywide's going out of business. They're going to pull all your warehouse lines. What are you going to do? And in 2 days, we were able to kind of take that business and put it on a bank's platform because our business was very high credit score, 15% down,
Mm.
purchase money business. So pretty
Yeah.
easy business. The bank was thrilled to have it. And that gave me the opportunity when we merged with the bank. There was nothing for me to do anymore. Bank did all the work that I was doing. So my partners and I said, well, why don't you go out and start trying to buy some real estate, start to create some type of a retirement account for us. And that's how our real estate business got started because I said, okay, I can do that. And not only can I do that, but I can take second mortgage lines of credit out against all these properties that I own that now have some equity in it. And we'll use that as our starter cash to go out and start buying real
Hmm.
estate. And that's kind of how we got into the space.
Yeah, no, that's great. I appreciate that. And the 10 properties paid off by the age of 45. At the end of the day, I mean that's still a good plan, right? Like that it's such a seemingly simple plan, but it's a great plan for a lot, right? Like yours has evolved obviously, at a much greater scale and you've grown an organization, but even if you want to boil it down to the basics, that plan really allows the average Joe to do something that's achievable and turn themselves into a millionaire or multimillionaire. And it's not rocket science to get there, right? It's just patience and discipline. So again, I know that was the original plan. It's evolved since then, but still a great plan. Interesting about the mortgage business that you ran. You'd mentioned that things started going sideways, and you guys got on that bank's platform. So did you not do any subprime? Because I know that subprime was I mean, that was probably made up the majority of loans that were being made back in back in those heyday times. Did you guys just shy away completely from the subprime stuff and only do prime?
Yeah, so we had a niche in two spots on the mortgage side. One, we looked at what at the time there was a company called Prudential Fox and Roach, and they had their own like loan officers sit in real estate offices, and it didn't really exist before that. And so we said, look, this looks like a way better system than going out and trying to generate leads
Mm.
on our own and all this stuff. And we got lucky that Keller Williams was just coming into the Philadelphia market at the time. And we got into like six or seven of their offices as they were opening up and expanding. And so all our business really came from that.
Oh, that's a great
Um,
piggyback. Yeah, that's
yeah.
great. Great timing there.
Yeah, it worked out okay. It
Yeah,
worked out okay.
fantastic. So let's talk about the evolution of the company. I mean, you had that simple plan. Obviously, times changed. You guys pivoted. You basically took some of the equity out of those first 10 properties and started building what is now, the Hal Group, right? Like that was the foundation. That was the baseline. Let's talk about those first couple of years. I mean, what was the plan thereafter? Yeah, I'm going to go buy some properties, but like, what was that bigger plan? I'm sure you guys probably sat down, put your minds to work, and tried to sketch out what the next whatever 1, 3, 5 years might look like.
And so, Kevin, you're gonna laugh because exactly what I did on the other side was I was like, look, I think I can add $100,000 a year in income in properties. So my goal is going to be to take 10 to 15 years, get us to $1.5 million in cash flow from properties. But the key is you guys got to pay me from the mortgage side. So we can just keep reinvesting all the money that we make on the development side. And if we can do that, I think over 10 or 15 years, we can get there. And that was the plan.
And how'd that plan change?
It
Or when
really,
or when did it change? I guess I should say.
so it never changed at that point because right now we're at about $1.5 million in cash flow.
Okay, I
It
love
took
it.
us 15 years to get there, instead of maybe 10, which was the low end of the cycle that I wanted to get to. But it didn't go in a straight line. So like there were a lot of ups and downs and changes and what assets we bought and that stuff changed. But really the goal of getting to $1.5 million in cash flow, took place at just, over
Yeah.
15 years when I probably wanted to get there in 10.
That's awesome. So let's talk about, I guess maybe some of the other parts of the uh, evolutionary cycle, more specifically the asset type. I mean, was it
Mhm.
always residential, or did you guys dabble in, retail, office, any other types of commercial properties?
Yeah, so we are 100% multifamily and single family
Hmm.
real estate, and that's
Hmm.
it. We've never deviated out of that market. And we had a couple basic tenets that were things that we were not willing to do. So one, we
Hmm.
were never going to take any interest rate risk. And two, even if we were going to build something to sell it, we wouldn't build it if we couldn't rent it and have it cover itself.
Yeah.
And
No, I
those
love
were
it.
our two basic things that we said when we got started because one of my partner's fathers built a bunch of condos down the Jersey Shore, and then rates went to 18% and he lost everything.
Mm. Yeah. Gosh.
And he kind of was formed by that experience. And we said, we're never going to do that. We're never going to take interest rate risk.
So where's that put your business today? Then obviously we've had quite a bit of volatility and with rates over the last 2 years, they're starting to make cuts. Just I think they recently just what a couple days last week they made a quarter point cut. And but let me I guess just the last couple of years have been challenging with rates going up to at an all time historic pace. Anyway, just in an 18-month span. So where's that guy put where's that put you guys in the grand scheme of things and basically following through with the business model? Obviously everything you had, it seemed it was probably in a good position, had good debt in place, but have things slowed down over the past 2 years?
So yes and no, right? Like, so the opportunities have changed over the last 2 years.
Okay.
But to go back and answer, like, the question you're saying that I think you're asking is, hey, over the last 2 years, if your basic tenet is, hey, I'm not going to take interest rate risk, what did you
Yes,
do over the last two
that's
years,
right. There you go.
right, to
Good,
make
good.
sure that you didn't take interest rate risk? And so when, let's say 10 years ago, it was very easy to get a fixed rate construction loan. You could get a construction loan that they would fix it in from construction through when it was stabilized for a couple of years. So
Mhm.
you could get 2 years of construction, 3 years of fixed rate afterwards. Well, as the sentiment started to change and the market started to change, those loans were no longer available. So we needed a new instrument in order to do that. And we found an instrument called a swaption.
Mhm.
And essentially all a swaption is it's a bet against an interest rate. It's not even tied to real estate. But I could go and make a bet with you and say, hey, Kevin, I'd like to bet that 2 years from now, when my project is done, that rates won't be above 6%. And if they are, I'm sorry, I'm going to take a bet. Yeah, that rates won't be above 6%. If they're above 6%, Kevin, you have to pay me 10 years worth of whatever that loan amount is. So if rates are 7 and I had bet you on 6, you would owe me 1%
Mhm.
for 10 years on whatever my loan amount is in one lump sum check. Okay, so I could protect my interest rate against 6%. In order to do that, I would pay an upfront fee to you. And let's call it a couple $100,000. If rates were not above 6%, you kept all my money. If rates were above 6%, you paid me out whatever that amount of money was.
Mhm.
And we took those on every loan that we took. And we did it for the last 7 years. So almost every time we lost the bet and we paid the money. But we didn't care because we had built it into our pro forma. We knew it was going to cost a couple $100,000, and we knew that we were now protected interest rate wise. So we would never
Mhm.
get in a situation where rates went up and we lost. So it's just like insurance where you're betting against catastrophe, right? We had a loan that we took that bet on, paid us over $1 million in one lump sum check because we had that interest rate hedge over the last 2 years.
Yep. No, I love it. No, good deal. And so, where is most of your activity focused today? Is it new development, ground up development? Is it existing projects?
So, three things that we're focusing on today. One, we are doing land development work, smaller pieces,
Mhm.
that we can get approved for 20 to 50 units, because there is definitely not enough for sale housing in our market. And
Mhm.
so to take things through the approval process and getting them approved, that land is valuable. So we're doing that. Two, we're looking for multifamily deals in the best markets in the 5 county surrounding suburbs because those rent levels substantiate new construction. They're the only rent levels that do. So, you're talking 350 to $4 square foot rents, right? There are
Wow.
markets that are 350 to $4 square foot rents for new product because new product doesn't exist in those
Mhm.
markets and they're the most affluent markets in the area. So that's the second thing we're doing. And then the third thing we're doing is we're buying assets that are complete that have some trouble to them. I got a vacant commercial space and 5 apartments that aren't rented. And now I got to write a $2 million check to refinance my loan because the rates went up 3% and I can't handle that. And people are selling buildings at discounts. Then we're buying those existing assets at discounts.
How much are you seeing that last one? in your immediate marketplace, like true distress like that, especially on a newer product?
Yeah, so a decent amount. Philadelphia had an
Mm,
odd occurrence where they had one of the best incentives for developers out there was a 10-year tax abatement.
mhm,
So when you got a zoning approval in Philadelphia, you would pay taxes on the land and nothing on the improvements for 10 years.
mhm.
So they decided that that incentive wasn't needed anymore and they were going to phase it out. Well, as you can imagine, developers raced to get all their approvals before they phased that out. And so there were 11,000 units that came to market last year when a normal market would have three, let's say.
Wow.
So just a tremendous amount of demand hitting the market at one time. And when that happens, if you haven't been through this process, if you don't have reserves, if you didn't hedge interest rate risk, well, now, you're calling investors and saying, hey, I need another check because the bank wants to see more equity from us. And people generally, when that happens, say, no, thank you. And then those assets are available for sale. So we've executed on three of those in the last 12 months.
Great. That's fantastic. I mean, it's unfortunate, right? That surely someone is feeling the pain there, but where there's pain is opportunity on the other side of that. No, that's good. I appreciate you sharing. One of the comments I made, or I guess per your introduction on the website, kind of just what spells out what you guys do. You provide, you know, A plus apartments at B plus prices with unnecessary amenities. What can you define what unnecessary amenities are? What does that mean?
Sure. So I'll give you the perfect example, right? Everybody wants a roof deck and a gym in their building,
Hmm.
right? And these roof decks have the most amazing set. Like a lot of them have pools on them now, and a lot of them have, entertainment centers outside, and all of these things. And I asked myself the question, well, if I lived in that building, how many times do I go on that roof a year? Three, four? But how much does it cost to put that in? And
Yeah.
then how much more do I have to charge in rent in order to do that? And our basic premise is, hey, look, I'm going to give you a roof deck with some standard furniture. If you want to go sit on the roof, go ahead. We're going to have a gym, but instead of our gym being 10,000 square feet and, a gym like you would get at a resort, we're going to have a gym that's functional, that you can use, has good equipment. I'm a workout guy, so I know how to make a, 1,000 square foot gym functional for the amount of people that actually use it.
Hmm.
And by doing that, that allows us to focus all of our time on, well, what's the inside of the unit look like? How do we make this unit more livable? So where are they actually going to put their couch? Where's their TV actually going to go? How will they live in this unit and then renew from us and feel like they had a good experience here versus something that's just super design oriented, but it doesn't really have functionality.
Yeah.
That's where we spend all of our time.
Okay. No, that's fantastic. Yeah, I've always wondered that. It's been quite a many years since I've lived in an apartment, and obviously they've changed over the last 20 years from the last time I had a lease. From what type of amenities. There was always, if it was a newer built apartment, it had a gym. It had some type of clubhouse, but that was 20 years ago. That was mostly it. Kind of like a gym and a pool. Probably a pool area of some sorts. But nowadays, I mean, it's like what new amenity can we think of, right? Dog park, I'm gonna barbecue area, movie area, co-working. I mean, like the list goes on and on and on. It's just, and some of those are pretty cool. Like I actually interviewed a guy the other day that they were converting it. They were taking over a fairly new project, and it had a substantially sized clubhouse. It was like 18,000 square feet or something like that, right? And they were basically modifying it, and they were converting 10,000 square feet of it to co-working, which I thought was unique based on the demographic. This is in Austin, Texas, right? So like it's got a younger demographic that they're serving, folks that are probably telecommuting that work from home most of the time. So I thought that was unique. But then again, it's unique. That's cool. That's trendy. But like, is it going to get used? That's really what it comes down to. Is it going to get used? And if you truly surveyed everybody, gave them the option of, hey, if I could save you $500 a month in your rent, but yet you wouldn't have access to any of these amenities, which would you go for? And I don't know the answer to that, but I'm guessing a lot of times folks would probably opt for $500 less a month. And then if they want to go to the gym, they're just going to go get a $30 gym membership, right? At the gym, at the local gym. If they want to go to the pool, they'll just go to their friend's house that has a pool. I don't know. I'm making assumptions here, but that's kind of what my gut tells me.
No,
Most of it's for marketing. A lot of it's just for marketing, right? The amenities are just for making the marketing pretty. And again, folks think they're going to use it. Most of the time, they just don't end up using it or use it very few times a year.
well, I think the really important part about that is there's a portion of the market that absolutely wants that,
Hmm.
but everybody's building that. Nobody's serving the portion of the market that
Yeah.
says, hey, I'd like that couple $100 less. It's like the colleges. The colleges are in an arms race for dorms, and we have to be better than this other school. And there's like, well, where's the great location, great, laid out building at less money? That's what I want.
Yep.
And that resonates with people, and we've stayed 97+% occupied based on that format.
Yeah. Got it. Are you guys vertically integrated with your property management?
Yes. So we have
So
our own
you have it
property
in house.
management.
Okay. Okay. Good deal.
Mhm.
What are you most excited about today? Like, let's look out 12 months. I mean, what's the chatter inside the office there that just has you guys super jacked up and excited?
So there's two things that have us really, really excited. One is we think we're finally coming back to a place of opportunity. The
Hmm.
last 3 years, you were building into headwinds and building into headwinds, right? And so when you get into that market, you need to make sure that you're a good steward of people's money. You don't lose their money. You still get them a return, maybe not the return they were expecting when you started, but a solid return on their money, right? And after you're through that, that means the market's now resetting and there's an opportunity. I believe there'll be a 2 to 3 year opportunity to do what we did 10 years ago when every
Mm.
deal was getting people 100% of their money back and just win, 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 win. I think we're coming into that kind of a cycle because I believe construction costs are going to go down. I believe long-term interest rates will go down.
Hmm.
Um, and I believe that rents will stabilize and start to kind of go back up. Philadelphia's a steady rent market. So 3% growth,
Okay.
unlike the Southwest, where the growth was, Southeast, Southwest, all of those Sun Mile states or whatever, Sun Belt states had just tremendous rent growth. We are kind of more a steady market, which we love.
Hmm.
So we think that there's going to be a huge opportunity to buy assets that are already done and build new construction. So that's the number one thing we're excited
Yeah.
about.
Is there any you guys you live in and you operate in, you have your entire life inside of Philadelphia. Every city, every municipality has its nuances and its challenges and its just barriers. I'm sure you guys know it like the back of your hand, but just generally speaking, are there any regulatory risks that currently exist or that might be coming down the pike in Philadelphia that could impact you guys? And if so, how do you guys navigate that?
Yeah, great question. So I think the biggest regulatory risk is any type of rent control or affordable housing initiatives that could potentially create problems. So there's one district or two districts in the city of Philadelphia where they passed any new project has to have a certain amount of affordability. And in those two neighborhoods, nothing is getting built. And so that's a real challenge because
Yeah.
the math doesn't work, right? The
Yeah,
math.
so how they define affordability, there'd be no way to build it without grants and abatements and all kinds of other things, right? Which probably doesn't exist. So the formula is flawed.
The formula is flawed, but what
Yeah.
we're trying to do is get ahead of that process. So
Okay.
I'm part of an organization called the Building Industry Association. Most major cities have one, and we're working really closely with the city. We've created a couple programs that will deal with affordable housing. Instead of just complaining about the idea, we're coming with solutions and saying, hey, if this is what you want to accomplish, let's do this. So one thing that we did, Kevin, is we went as the development community and said, hey, you know what? Why don't you charge us a 1% tax on everything that we build? And then take that 1% and use it for affordable housing, but use it for affordable housing with the private market. So you don't have the inefficiencies of the public market. And now we can deliver you units cheaper. And
Hmm.
through that process, we've focused on home ownership versus rental, but we've been able to work with the city, use that money, get land that the city has, and now
Hmm.
develop affordable housing at a rate that makes the city happy. And now they're saying, okay, great. These guys really care about the market. They really care about what we're doing. Now let's work on how do we do it for rentals? How do we keep naturally affordable housing from going away? And so we're in the right conversations to keep the regulation from just being thrown out because now we all work together and trust each other.
So that initiative that you just spoke to, that already has legs. That's already in effect and has been rolling, it sounds like, for a number of years.
Correct. Correct. We put the construction tax in place a couple of years ago, I think 2 or 3 years ago. And then the city did a great job. They went out and got $400 million in bonds against it. And now they're using that money to help deliver affordable housing. It's been a fabulous
That's
kind of
fantastic.
interaction of the city and the private sector to solve a problem.
Yeah, no, that's fantastic. Just curious, like what did that equate to over the last couple of years, that 1% tax?
Yeah, that's it.
Just
I know they
yeah,
got $400
yeah.
million in bonds based on what they expected that the track record was going to be. And I think that probably played out to be about right. So
Is that normally like a 1-to-1 ratio with obtaining bonds? Yeah, I don't know. So that's why I was wondering.
yeah, that's a great question. I don't really know
Yeah,
the answer to that either. I could
yeah, no worries.
probably go back and get it. But what I can tell you is if you want the practical translation of what it's actually translated to, the city is paying approximately $70,000 a house that we build to buy down the cost of the house so somebody can buy it at 60 to 80% of the area median income for a new construction house in the city of Philadelphia. That's practically what's happening.
That's awesome. And what type of financing? Who's actually doing the loan? Is that like an FHA, it's a standard FHA loan, or
So it's a grant from the city that's the
for the
$70,000.
for the buyer though, for the end
Correct.
buyer? Yeah,
It goes to the end buyer, and then they could get a conventional loan, they could get an FHA loan. They have to go through a housing training program with the city before they're
got it.
eligible, and it all kind of filters through there. And it really is a tremendous job because 85% of the buyers are coming from this city program, and it's teachers and nurses and firefighters and police officers that are just getting started that now can buy a brand new construction house in the city they live. It's
That's awesome. Yeah, kudos, man, for helping be a part of that, put that together. That's really cool. So you've done hundreds of transactions over the last couple decades. Hopefully, many more positive ones, successful ones, profitable ones, than ones that maybe wreaked havoc on your stress levels and your team. But those are the ones that really shape us into what we are here today. Successful entrepreneurs, and so. But I think we learn a lot from those challenging ordeals. So is there a deal that comes to mind? I'm sure you've got many. We've all got a lot of war stories, but is there a particular deal that comes to mind? One that just created countless sleepless nights, just undue stress to you and the rest of the team, and maybe even financial distress. One that you've learned lessons from, whether you made it through the other side, if you did, maybe lessons learned along the way, how you overcame the adversity, or maybe it's one that you just almost bought and you backed away from. You killed the deal just for XYZ factors. But what comes to mind? Anything you'd like to share? A particular deal, please.
I have tons of great
I
stories
know
along
you do.
these lines, but I will tell you a couple, and most of them have worked out. So we bought a property. So one of the ways we got started, we just so happened to Temple University was growing, and they didn't have enough housing, and there was a lot of land kind of right off of the campus that was available to be bought. And so we were buying that land and building duplexes and renting it to the students, and it was a tremendous, tremendous business. So, but what happened was all of a sudden people started looking at it, they started coming to the market and going, oh my God, this is like uncharted territory and there's so much property and the kids pay so much rent. And so the area got inundated with students very quickly. And there was no way to deal with the unintended consequences of that. Like imagine you're renting a 4 bedroom, 2 bath house with a huge living room and an empty basement out. The kids like they're going to have the craziest parties you could ever imagine in these houses, right? So that starts to happen. And us trying to be good stewards of the neighborhood, we're like, look, we don't want to go in a neighborhood and make it worse than it was before we got here. So we've got to solve this problem ourselves. So three or four of us as landlords, we get together and we're like, hey, how are we going to solve this problem? And we go to the council person whose district it is. We're like, hey, the only way we can come up with is to create security for Thursday, Friday, Saturday night to go up and down the streets and make sure that nothing crazy is happening. And we propose that you create a business improvement district and tax the landlords. So, because seven of us together can't do it. But if you tax all the landlords, there'll be enough money. We can keep this under control and everything will be happy. Everybody will be happy. Well, imagine that then the council person goes to the community groups and says, hey, the landlords came to us, they want to tax themselves. And they go, something's not right about this story. Literally turn it down. They have to vote on it. It's a council, the whole neighborhood votes against it. So we couldn't get them to help us kind of make the neighborhood better. So we decided we just need to get out of this neighborhood. We can't be here then. Like we're trying to fix a problem that we created, but if you're not willing to help us fix it, then I don't want to be here. And we sold all of those properties that were tremendous cash flowing properties.
Hmm.
And we bought a piece of land right next to it. Everybody that's seen the Rocky movie sees and runs up the art museum steps. We bought a property right next to the art museum steps. And it was a buy right approval for 60 apartments. And we're like, this is going to be great. We have A plus real estate. We're going to build this 60 unit apartment building. And I get a call from the local neighborhood group and they say, hey, can you come in and talk to us? I said, yeah, no problem. I come down there like, hey, where's your attorney? I'm like, why do I need my attorney? Like, I thought we were just, this is a buy right project. You're allowed to do it. And they had a couple people that were very influential politically. I won't mention their names, but they sat in a room with me and they basically said, we'll turn that into a bird sanctuary if you don't, and we'll
Oh
allow you to
my
put two
gosh.
houses on it. Now, I had sold properties that were making over $150,000 in cash flow to me a year, and I'm going to put into this. They're going to let me build two houses on it, and it
Wow.
was a disaster, a total disaster.
What was the opposition? What were the reasons they wanted to keep it as vacant land? Had it been anything before, or it had never been developed?
So it was a convent for the local Catholic school. So in our design, we kind of designed this whole building to keep the convent and keep it in place because we thought we knew what the neighborhood wanted. But really, what they were concerned about, and we knew it going in that they would be concerned about parking, right? You're going to put 60 units in the middle of a neighborhood where parking's already constrained. And so we knew that going in. And in hindsight, I should have went and talked to them ahead of time instead of getting the approval, posting it and saying, hey, I'm approved. I should have went to them and said, hey, here's what I'm thinking of doing. I know it's going to create some headache. Let's talk through some good options. I didn't do that, and it became an adversarial situation that probably didn't need to be.
So what
Um,
happened? What was the final outcome?
so the final outcome was they let us build 10 townhouses on the site instead of the 60 apartments. But I had to, for the first time in history, go outside my tenant of I'm going to build something that if I can't sell it, I can't rent it because these are now $1 million townhouses. And nobody had ever built $1 million townhouse on that side of what was the parkway before. So it was sleepless night after sleepless night because I didn't have any choice. I couldn't leave it as two properties. It was worthless to anybody else, and I had to make our money back. And so we built these 10 townhouses, and they ended up working out. They ended up selling for 1.3 million, 1.4 million, and we got our money back, plus made a profit. But it wasn't what we expected to do, and we lost a lot of cash flow in the process, right? We had great cash flow on these properties at Temple, and now we have cash to reinvest, but I don't have any great place to put it after 3 years of developing townhouses and selling them and et cetera.
Oof. What time frame was this? What year did all this occur in? Like when the product was actually done and ready for sale, the townhomes. What year was
I would
that?
say it was probably 2017,
Okay.
2018.
Okay. Okay. Got it. Yeah. So yeah, I guess no matter what, the timing still, even if it would have been delayed a number of years, I mean, obviously, it probably would have even turned out better maybe during COVID, right? I don't know what the prices go from, like you said, 1.2, 1.3 is what you're selling them for. If it would have been a few years thereafter, call it. late 2020, 2021, when, the housing market went on a run, what would they have sold for?
So the resale that I saw of one of those houses was 2.4 million.
Wow. That's crazy. Absolutely insane. So, I guess to summarize it all, what would you have done differently? You would have probably gone and actually talked with this group first ahead of time, been proactive about it, and maybe tried to address some of their concerns in advance of maybe closing on the property. Is that what you would have done?
That's definitely what I would have done, Kevin. And I will tell you a couple other things that we've learned throughout our process that I think are really helpful. One of the things that we now feel very comfortable going into any community group or any town meeting to talk about a project and get feedback from the community and then come back with a project that works. And it's all about the process. And our process is twofold. The first thing we say is, look, we're here. We want to develop this property. We want to make it better. We want to make it a better asset for the community than what it is today, right? That's our number one goal. In order to do that, you guys probably aren't going to get everything that you want.
Yeah.
There's things that you're going to be able to get, and we're going to try and address most of those issues, but you're not going to get everything you want. So if you can live with us working really hard to make this good for you, we're happy to do that. And then this is what we do. We hear all the issues. Then we send a survey out to everybody, say, hey, here's what we heard is the top 3 issues. Is this right or is this wrong? And if it's wrong, they give us more issues. Then we total up all the surveys. We go back to the second meeting and we say, hey, we came back from the meeting. It looks like 80% of the people are concerned about the setback from the street and 20% of the people are concerned about parking. Is the setback more important? In which would you give up parking for the setback? Yes, we would. Okay. So now we're having a conversation about the
Hmm.
real issues instead of what will happen if you don't do it that way is people will just stand up and the loudest person, whatever their issue is what everybody thinks is the biggest issue. And generally it's not. And
Hmm.
as soon as we went to this process, we've gotten community support for every project that we've done since then. We've not had one where we've gone in and not been able to get the community behind the project.
Yeah, that's awesome. Yeah, we live and we learn, right?
Absolutely.
That's that's fantastic. So, yeah, no, that's great. I appreciate you sharing that story. Again, we build character through those types of challenges. So we wouldn't be where we're at today if it weren't for those challenges. Again, while they're happening, though, you wish that they would just it's like, damn it, just go away. Let me get on with life, right? Because they're draining. They take a lot of bandwidth and mental energy. But I'm glad you made it through the other side. I'm glad that it was profitable. At the end of the day, uh, you know, for those, Gary, that want to learn more about you and your firm, what it is you guys do. Maybe even I'm assuming you take investments as well from high net worth accredited investors. Do you take retail capital like that?
We do.
Okay.
We absolutely do. And the good news is, for the most part, this is the first time ever. Actually, it's a great point that you bring up. It's the first time ever that I'm raising capital where I'm expanding my network a little bit outside of a core group of people from Philadelphia.
Yeah.
We're doing a $13 million raise now for a project in Kenwood, which is one of the premier suburbs in the city of Philadelphia, best school district in the area. And we're going to build a 94-unit apartment building with about 5,000 square feet of commercial space and 118 parking spots. We love it because of the barrier entry to get into that
Hmm.
market. It's really, really difficult. And we've done 2 of these projects recently, like I talked to you, at that higher rent level.
Hmm.
And they have, there's waiting lists to get into them. So
That's
we're
awesome.
thrilled to kind of have this project teed up and in a market. It's our first new construction in 3 years, to your point
Hmm.
that you made earlier, because the math just didn't work. This deal works wonderfully. Our expectation is that we're going to give 2.1 times your money back in 3 to 4 years, 18 to 20% IRR to the investor, net of all fees, expenses, that kind of stuff. So a deal that we're really excited about. We've taken all the risk factors out, like you had mentioned earlier. We don't have any interest rate risk in this deal. We have about a 10 to 12% contingency for construction and, for any of that stuff. So we feel really comfortable that this is a project that's going to be really successful and like they were 10 years ago when we were doing them.
No, that's great. It sounds exciting. I mean, for those that want to learn more, is it just go to your website and reach out to you, or where's the best place to track you down?
Yeah, so they could just either email me at Gary, Gary, at howgroup, HOW group.com, or they can go to our website, thehowgroup.com, or look me up on LinkedIn, any of those three places. I'd be thrilled to talk to them.
All right, fantastic. Well, Gary, I appreciate you coming on the show. It's been a pleasure having you here. And guys, I'll get all that information down in the show notes as well. And with that, my friend, good luck on this project and all the future projects you got coming down the pike. And appreciate you sharing your story today.
Absolutely, Kevin. If you don't mind, could I give you one other thing real quick that I think
Yeah,
might be
yeah,
exciting for
please,
some of your
please,
listeners?
please do.
Um, we One of the things that we believe in as a tenant is creating wealth through real estate and creating passive income
Hmm.
from real estate. So your cash flow book that's sitting behind you, that's what we believe in, right? And we want that not only for us, but we want that for our tenants. And so we were searching around, and we invested in this company called Nito, Nido. And what the company does is it helps your tenants become homeowners by creating a savings account for them. And this savings account basically takes 5% of what they're paying in rent and puts it aside for down payment on a house for them. But
Hmm.
the money doesn't come from the landlord, it comes from the program. So the landlord pays nothing. The tenant starts to build up savings to buy a house. The landlord gets the following: a tenant who stays longer in their building because they're accruing this money to buy a house, they get a higher conversion rate when the people are first looking at the apartment because they're like, hey, all things being equal, you're offering me this savings and nobody else is. So that's the second thing, right? Higher conversion rate at least or of potential tenants up front. They stay longer in the building and they give you better reviews. That's what you get as a landlord.
What was, help me understand. Now that's great. So Nito, Nido, is that what it was?
Yep.
And where's the money coming from? Is it just the tenants are paying an extra 5% or whatever? No,
So
who's funding? Who funds it?
yeah, so great question. So what Nito has done is gone out and negotiated deals with service providers, and they take the money from the service providers that end up being part of the transaction. So like the real estate agent, the title company, and the mortgage company, they accrue money from those guys and give it to the tenant. They also scrape the databases to see what grants are available to them. So on top of just what you're getting from that kind of 5% a month, they'll also show you what grants are available to you. And they give the landlord some money that's discretion, like, hey, if you renew your lease 2 months early, we'll put a $300 extra in your account. The average person's getting $3,000 to $5,000 towards down payment on a house from this program. And it's a huge win for us. Like our ratings as a landlord have gone up, our retention of our tenants has gone up, um, and our conversion on the front end has gone up. So when we invested money in this company and they deployed their program into our buildings, we have 1,500 units that we own. There were 20 buyers last year out of it. So
Wow.
not this
Yeah.
mass exodus, but it's a 1%, 1.5% close rate a year of your tenants. But it creates such a great,
It's a
story for you as
win-win.
the landlord. Right. It's a
The
win-win.
win-win. Yeah, absolutely. I mean, for those, I mean, there's some folks that they don't want to. I mean, they don't want. They're happy with renting. They don't want to deal with
Mhm.
the other responsibilities of being a homeowner, right? But there's a contingent of renters that want to live that American dream. They want to own it and they want to have that responsibility. And so it sounds like this program serves the exact person it was meant to serve. So no, that's fantastic. I appreciate you sharing that. So is this available? Is this a program available to any and all landlords throughout the country, or?
That's correct. We were the beta test for them. That's why they came to us and said, "Hey, we want to beta test it with you guys. I want you guys to invest some money in it." We love the beta test. We invested some money in it, but yeah, it's designed to be available across the country.
No, that's
Anybody that wants.
fantastic. Well, I might ask you for an introduction. I should have, bring them on the show and talk about their service. That sounds like a pretty cool service.
I'd be happy to introduce you to
Yeah.
the founder and get you in touch with them.
Yeah, fantastic. Well, awesome, Gary. I appreciate that. I really do. And appreciate all that you've shared here today. And guys, we'll make sure we get that in the show notes as well. And with that, my friend, appreciate all you've done. Keep doing, keep kicking butt. And yeah, if I ever make my way up to Philadelphia, I haven't been to Philly for like 20 plus years. I'll be sure to look you up. And the same goes to you. If you make your way down to Tampa Bay, please look me up. I'd love to buy you lunch.
Awesome. Thank you so much, Kevin. I appreciate what you're doing and I appreciate your time.
Alrighty, guys, that's all we have for this week's show. So until we meet again next week, this is your host, Kevin Bupp, wishing you huge success. Take care now.